Understanding the payout ratio in dividend investing. As dividend investors, we want to ensure that the dividends we receive are safe and that the company will continue to pay them. The payout ratio is something that we calculate as a key metric to help us determine this. We give in the example of the video Stan and Jan's dilemma. Stan is considering if he should invest in Allstate while Jan is looking at MetLife. A stock or share represents ownership in a company. For example, MetLife has a little over 79 million shares outstanding. Buying shares makes you a part owner, entitling you to a portion of the company's profits as dividends being paid to you. Dividends are the cash payments deposited into your trading account for owning shares in a company. So, for example, if $1 per share is paid on 1,000 shares, you'll receive $1,000 annually. As long as you hold the shares and the company continues to pay dividends. That's why we calculate what's called an EPS. It's essential to understand EPS, or what we call earnings per share. EPS represents the amount of money a company is making per share. To find a company's EPS, you can visit websites like Yahoo Finance, free websites like Google Finance or MSN Money. For example, MetLife stock symbol is MET. We calculate the payout ratio to help determine whether to invest in a company. We follow this formula. The payout ratio is equal to annual dividends divided by earnings per share. Let's consider our examples of Jan and Stan. MetLife is what Jan chooses, and their earnings per share are $3.95, and their annual dividend is $2. The payout ratio is $2 divided by $3.95. That equals 51%. This means MetLife pays out 51% of its earnings as dividends. The remaining earnings are reinvested back into the company. A payout ratio of 75% or less is considered healthy for the company, and it indicates that the company has room to decrease or increase the dividends in the future. Allstate earnings per share is $3.08. Their dividend is $3.40. If we divide that, we come up with 110%. In this case, Allstate's payout ratio is 110%, meaning that the company is paying out more in dividends than it's earning. This is unsustainable and a red flag, which indicates that this company does not have the money to continue making payments. Interpreting the payout ratio is an indication that we see on this chart that I've made here to the side. The company has limited room to increase dividends if it's 75% or over. The company might have to reduce the dividend in the future if that number is anywhere over 75%. Sometimes we can calculate payout ratios of 200 or 3%, and those are big red flags indicating that the company has a significant financial strain. Now, if we compare MetLife and Allstate, like we have on this chart right next to me here on the video, we are looking at the numbers to determine the investment potential or the risk. MetLife appears to be a more secure investment due to its sustainable payout ratio and potential for future dividend increases. I want you to avoid making investing mistakes. Paying attention to the payout ratio can save you from costly investing mistakes. Avoid companies with unsustainable payout ratios to ensure your dividend income remains secure. Many platforms, such as free platforms like Yahoo Finance, MSN, etc., automatically can calculate the payout ratio if you can't. Highlighting those above 75% are easy to identify. Remember, Stan and Jan, investing should be done when quality dividend stocks are undervalued.